Crude oil prices, which topped $70 a barrel yesterday, are retreating today. Let's take a check of crude oil right now and see where that is trading. Crude is down just 1.6%. It's trading at $69.07 a barrel. Traders cited slowing consumer spending, especially for gasoline, which fell to a 6-year low during the first 5 months of this year. Joining us now is Kevin Book, the founder, president, and CEO of Clearview Energy Partners, a consulting company. Clients include institutional investors as well as oil producers and refiners. Kevin, welcome to Bloomberg News. Good to talk to you again. And as I mentioned, oil retreated from $70 a barrel today. What's behind the decline?
Well, I think it's a bit of a reality check, Mark. There's been a lot of expectations that green shoots were going to grow like a beanstalk, and you're coming back to earth. You've got fundamentals that show gasoline demand isn't going up, and quite frankly, neither is jet fuel or distillate demand. The world simply isn't using more oil. Wherever the recovery is, it may be jobless and oilless as well.
As I was speaking to a guest earlier this morning on Bloomberg News, there was a column in the Financial Times in which the op-ed piece said that maybe the green shoots could be a little bit misleading. Do you sense that as well?
Sure. There's a misconception about what oil represents for, I think, at least some of the investors right now. The expectation that oil is a hedge against a weak currency, for example, or differentially weaker economy isn't necessarily true, since the U.S. is the biggest consumer economy of oil. If we are, in fact, weak, then we're using less oil, and, in fact, it's an industrial feedstock. It's an input that we won't be needing as much of. So I think that perhaps the green shoots have to be a little bit bigger before you start to think oil is a buy.
Well, what price seems to make sense right now?
Well, the easy answer is the replacement cost, whatever that might be. And we've had a lot of cost deflation in the services and in the marginal variable cost components of production. We remain at $55 on a year average if the economy is weak, and at sort of modest recovery level, we would get to a $70 year average, but we don't think we're going there.
Well, we have some analysts who say that the $70 a barrel price doesn't make sense right now, given that the fundamentals of this global economy are still sluggish. Is that your argument as well?
Absolutely. It's easy to point to China and say, wow, look at all the products demand. It's about as much as the jet fuel in the United States that we're not using. Wait a second. So the growth market that is the world's incremental demand for oil is just one tiny component of what we're not doing here. We're still the fat tail of the distribution. You have to look at the big dog and see that it's not moving. In fact, it's kind of retreating.
Well, is speculation behind this recent rally, do you think?
There's always short-run effects because of speculation. It's a tendency sometimes for optimism to move contracts around a little bit. But this is a physical product, and it eventually converges back. I think that speculators who didn't learn their lesson last year are still due for perhaps a second course.
Well, given the sluggishness of the economy, oil and other commodities, you think they're becoming a major asset class for investors right now?
That's certainly true. The influx of money from long-only index funds has been, in fact, the birth of a new asset class. And that's where I think that we need to ask some serious questions about what the difference is between oil and gold. If they'd called it, for example, black iron, maybe we'd understand that it was an industrial input that correlated more closely to the behavior of the broad macroeconomy.
Well, Congress, as we speak, is debating this bill that would limit the emissions of greenhouse gases. How would this impact the oil industry?
It increases costs across the economy in small measure, and they're giving free money back to some of the sectors that are affected. For the refining sector, though, in the U.S., you've got 31% of the greenhouse gas emissions getting 2% of the free money. So that means a bigger pass-through of price at a time when demand is weak. It's broadly negative, quite frankly, for the refiners.
Kevin, let's switch overseas for a second. Saw a story today that piqued my attention. The Russian President Dmitry Medvedev, he is in Angola, a member of OPEC. He held talks on closer coordination of oil policy with the cartel. Is that going to have an impact on prices, do you think, if Russia and the cartel start to see a little bit more eye to eye?
Yeah, absolutely. There's been a couple times in history when the Russia plus OPEC, call it ROPEC, has actually had some effect on price. But ROPEC last year didn't do anything because Russia backed away. They didn't end up integrating last year, and right now it's a very self-interested, perhaps a bit late move by Russia, because you're already starting to see some opportunistic behavior by the other OPEC producers, not least Angola, which has tremendous upside if they could just sell more oil.
And that's interesting. Medvedev said today we're not entirely satisfied with the state of the market. The oil market shouldn't be dependent on the situation in a single economy.
Well, if you want to diversify by using more oil, I suspect that will be the outcome. But in the near term, that's not the way it works. We may be slow growing or even declining in our transportation use of oil, and other economies may be racing ahead, but we're still 23% of world demand.
Kevin Book, founder, president, and CEO of Clearview Energy Partners, joining us from Washington. Kevin, thanks.